The following content is meant purely for educational and informational purposes and should not be relied upon as financial, investment, legal, tax, or any other professional advice. This is the Fundamentals Podcast, where we demystify crypto and help you navigate this ever-evolving internet-native economy.
In this episode, we're joined by David Hahn, an institutional research analyst at Coinbase, to discuss the latest market trends, on-chain developments, and David's journey into the crypto space. Our conversation covers the purpose of Coinbase's research team, the state of on-chain analysis, and more specifically how important access to verifiable on-chain analytics for different crypto projects is. We speak about the state of Bitcoin and Ethereum ETFs and where the difference in traction stems from. We touch on Bitcoin dominance and dive into Ethereum's current scaling roadmap and address how L2s might be slightly extractive.
Hey, David. Welcome to the Fundamentals Podcast. It is great to have you on, man.
Thanks for having me, Oscar. It's a pleasure to be here.
Of course. I've really been looking forward to this one. Just before we started recording, I said I've been reading all the research that you and the rest of the team have been putting out, and I was trying to pull some insights from there. So excited to dive into your view of what's the latest in the markets and speak about some on-chain developments in addition to, of course, yourself and how you got into the space.
Thanks. I mean, it's super exciting. I feel like, the stuff that we write is definitely, I feel like there's not that much, institutional level research in crypto right now. So I do feel like, it's us and then maybe a handful of other firms. A lot of it still is, very much geared towards, the retail aspect of things, very, very niche, very small opportunity. So it'll be pretty cool to discuss this with you.
Yeah, exactly. Very niche. And even though we're speaking about, here, a brand as large as Coinbase working on super big initiatives in the space, the research team itself that you're part of is quite small. And we'll get into the details there in a bit more. But just starting from there, I would love if you can give us a quick background on who is David Hahn and how has your journey led to you being at Coinbase?
Yeah. So I actually have a background in computer science and math, and I've always had an interest in, finance and behavioral economics. And I think this is a pretty common story in crypto where, crypto really sits at the intersection of all these things. So for me, that was just, a very, very great draw. I was working at Goldman previously. I was a software engineer. I was on the research and development team, and I've always had an interest in crypto. And then when they opened up their digital assets team back in 2021 or late 2021, early 2022, I was like one of the first people to hop on there. I was like, hey, please move me to that team. That was super exciting. And that was super exciting for about a year. I was there when we didn't have any idea. We just wanted to do something in the space, all the way through to when we eventually developed and designed our tokenization platform. But at the time, 2021, 2022, the regulation side was still very, very oppressive on crypto. There was not that much stuff you could do, especially sitting at a bank, a US regulated bank. So everything we were doing was very private blockchain. There was a lot of focus on just very, very siloed work. And then I was like, all right, I kind of want to expand my, breadth of skills a little bit. And I switched over to a research role. And so now at Coinbase Research, I feel like my technical background gives me a bit of an advantage, especially when it comes to technology-driven crypto catalysts, and then kind of marrying that with the macroeconomic views I've always been passionate about. And so, I've done a lot of self-studying, self-writing on the side. And then that's really helped out with getting me to where I'm at today at Coinbase.
That's awesome. Thanks for sharing that context. Now I got to ask that when that role came up over at Goldman to start working with digital assets, what size of a team really was that they put together at that moment? Because looking back, I feel that with a lot of institutional players that first started dabbling into crypto, it was like a 1 to 3 person operation that was kind of exploratory. Was that the case, or was it a larger scale thing?
Yeah, no, it was definitely fairly exploratory. Actually, I think that the year was wrong. When I first joined the digital assets team, it was not talent of 2021, it was the talent of 2020. That's when they started making the team. At that time, there were 4 to 5 people on the team. I think I was the 4th person to join part-time when I was doing the transition. But I think we fairly quickly scaled up quite a bit. Within the course of the next 6 months to a year, we reorged another entire team into the digital assets department as we got a clear roadmap. When we decided, hey, we want to work on this tokenization platform, this is going to be a big engineering effort. We pretty quickly scaled the engineering side up to like 20, 25 engineers who are all working on that. But when I was there, when I first started, it was still very much like, hey, like, what are we going to do? Are we going to build a wallet? Are we going to build up like a permission lending platform or trading platform? And then eventually, once we got more clarity on what we could do, given the regulation and the technology risks that we wanted to take, then we figured out we wanted to do private blockchain, we wanted to do tokenization, and then we scaled the team up pretty quickly.
Awesome. Yeah, and I want to speak about the learnings and kind of insights from being a part of building that tokenization platform a bit later on. But before we get there, let's start from Coinbase because that is super exciting and what you do on a day-to-day basis nowadays. And as I mentioned, the research team from the outside in looks pretty small. You have like curated research that you put out, very targeted in a way. So if you could help us understand a little bit of what the role of Coinbase's research team really is at a high level.
Sure. Yeah, at a high level, the Coinbase research team, we sit under, so Coinbase has two arms really, the institutional arm and the retail arm, very broadly. We sit with the institutional arm. So we work very closely with our sales and trading team. We help our institutional clients. We give them market color. I think most traditional financial services, a lot of prime brokerages or whatever, like Goldman, JP Morgan, they'll write research. We kind of operate in a similar capacity. We also help with ad hoc requests internally, but very largely we are focused on delivering market color to our clients that they might not otherwise get. For example, some macro funds might not know as much about crypto native catalysts, vice versa, right? Some really great crypto VCs might not know as much about the economy and what's unfolding there. And so we really kind of tailor to what our clients need.
Okay, exactly. So delivering color based on clients' demands. That was going to be the next question, that how much do client demands shape, just the internal focus of what you do at research? But that makes complete sense. How much of that is driven by, market trends? When we think of the demands that's coming from clients, is it market trends or more like longer term strategic goals that these clients have in understanding specific things about the space?
Yeah, that's sort of like I would say a 50-50. So, our published research, our written research is all available online. We have a weekly market commentary, so that's very much like real time what's happening last week, what's happening this week. We also have a monthly outlook that's a little bit longer term. And then we also do kind of more sector reports, so like, crypto AI, inflation, ETH and L2s, like these sort of things that we look at. They're more general, like longer term themes that might be like 6 months to a year, then they might play out. But really, we kind of focus on, I would say, the day to week to month range, not as much on like the 10-year vision of crypto. I mean, we do discuss that sometimes, especially internally. We like to have our philosophical debates, but a lot of it's very much markets driven.
Yeah. And what I do love about your research, that it's not just very high level visionary that this is what could happen, but you also have very data driven commentary and analysis on specific sectors, which is always great to see. And especially from Token Terminal's perspective, working with on-chain data, that's what we want to see. And we're always interested in understanding like what the demand from different stakeholders in this space is coming towards on-chain analytics. So are you able to shed any light on how you're seeing institutional interest or like questions related to on-chain analytics develop in this space? So is it like already a part of the decision-making processes, or are they more interested in just general, conceptual learning?
Yeah, no, on-chain data is super important. I think that as more institutions step into the space, the understanding of how important different types of metrics are is definitely growing. I would say, some of the more traditional firms don't really get some of the crypto metrics, right? What does it mean? Like, if there's like congestion or like, costs or active users might, be there as well. And more importantly, the bigger question is, how do you interpret these metrics? So for example, something like active users on a blockchain is probably very, very, very different from active subscribers for like a regular Web2 or a SaaS, because, you don't really have Sybil problems. You don't have airdrop distortions, right? Sometimes we talk about like how like we've seen, a 300% increase in users over the last week, and people, in the TradFi world might be like, how's that? How are you scaling that fast? Like what's happening? And then you have to kind of explain these things. So I think the most important thing is not just using on-chain metrics. It's really kind of walking people through when certain types of metrics are appropriate, how different incentives kind of color these metrics, and really kind of painting a picture saying, hey, normally we'd use this metric and here's this metric, but you have to temper that with the expectation of this other thing that's happening in the background that might be distorting it in the short term. So I'd say kind of interpreting metrics is really, really key. And I think one thing that is also kind of being really, really looked into now is the durability of certain metrics. So there are certain things that have been, changing very fast in the ecosystem. It's not like, hey, we're going to have this annual recurring revenue that's going to last for, the next 3 years. You can't really draw out, 5-10 year projections in crypto. It's more like, hey, we have this thing, but remember, this is probably only going to be here for a few months. How much of it is like hype driven? How much of it is narrative driven? So I think these are all questions that on-chain analytics can help with, but they're not like the full picture. And I think that full picture is really where institutions care about, and that on-chain metrics just kind of help paint that picture.
Really well said. And when we think of that, I mean, we try to standardize metrics as much as possible over at Token Terminal to make them comparable to what you'd see on, say the Bloomberg terminal, or just what traditional financial analysts are used to seeing. From that point of view, are you seeing that institutional investors are analyzing crypto protocols utilizing similar frameworks than they have in traditional finance? Or are they seeing this as a completely different approach now that we have on-chain data that is slightly different and a bit more noisy?
I think there's definitely been attempts to to use the same approach, but all those like regular, TradFi valuation models, they kind of fall short when it comes to what actually happens to token prices. And so the
Yeah.
point of models generally is to kind of give you a sense or a guide of what historically might be appropriate when it comes to, trading as like a market cap size or based on volumes, etc. None of these really apply to crypto. And so when you try to apply these volumes, you say, or when you try to apply these models, you say, oh, okay, so these models make sense. If you can have some sort of like, earnings ratio. And then you look at the actual token price and you're like, wait, this thing has been trading, 3, 5, 10 times higher than what it should be, if not more. Where's the extra, valuation coming from? And it's not like it's kind of fluctuated around that, historical model. It's just like, no, it's just been 10x what the model has said since inception. And then that's kind of where these models fall short. So I would say that there's definitely attempts to do that, but the approach has to be a little bit different. And I think most of especially the crypto native firms who are looking at more of these altcoin space, like they do look at different models.
Yeah, there is a big discrepancy between the actual fundamentals and price action right now. And that definitely throws people off because when you try to put them in models, then it looks wrong, even though you try to compare it with something in TradFi. How about from purely an analyst perspective? Because you for sure consume a lot of content. You live and breathe on-chain data. You're trying to find new trends and things that are happening on-chain. Do you specifically see any specific metrics or trends in the on-chain data space that you think are underutilized by the market today?
Yeah, I think the one that I would think of the most is metrics that are more Sybil resistant. So how do you filter out the noise? I think the one that actually I came up with a metric and I kind of wanted to point that out. I wrote a little paper about something called the H index. And so the H index is a concept that's borrowed from academia. And it's a measurement of how impactful an author is, really. So in academia, the concept is the H index of an author is how many papers that person has written with at least that many citations. So if an author has an H index of 100, that means that he's written at least 100 different papers with at least 100 different citations. And so what this kind of helps eliminate is, say, if this one author has written one paper that has 1 million citations and no other papers, his H index is 1, right? Or if he's written 1 million papers with only 1 citation each, then his H index is also 1, or her H index is also 1. And so what this kind of does is kind of like it draws out a little bit of a balance between how much variability there is with how much activity there is per area. And so the way I kind of adopted this to on-chain metrics is I look at the number of distinct receiver addresses that have received that number of unique interactors. So if you say like, oh, a blockchain has had an H index of 100 over the last day, I mean, you can have different time frames, but I did it over a 24-hour period, and you say, all right, look, on Ethereum, 200 different smart contracts have had at least 200 unique users, right? This is a lot harder to kind of Sybil, farm, or whatever. And so that kind of says like, all right, the activity is quite distributed. And I think it's harder and harder to grow the H index. Like it's very easy to go from 1 to 10, right? You only need 10 smart contracts with 10 users. But to go from 200 to like 210, you need another 10 smart contracts each with at least 200 different users. So the growth tapers off towards the end. And so that kind of eliminates some of the noise. And I wrote a paper about that. I would encourage viewers to go look at that. I think that it's more Sybil resistance and it kind of shows more resilience during market downturns. I mean, it's not perfect, but I think that there are certain types of metrics that can provide clearer pictures, but they're not as easy to use, or you might have to think a little bit about how you might apply them. And even the H index, I don't think you should use it straightforward. Oh, this is like end all be all, it's everything. But I think you can use that in conjunction with broader, what's the total number of users? How distributed is user activity? And you kind of paint the picture using a series of metrics like this.
That is absolutely fantastic. I will be linking that paper into the show notes because I think everyone should be looking into it, because that's something that we've also tended to think about a lot. You need to add filters, quality filters to all the metrics that we're looking at because there's just so much noise. Are you able to share what the process looks like of you putting together a metric like this? So where are you sourcing the data to be able to apply those quality filters?
Yeah, I would say 2 or actually, we actually use a number of different data sources. We do a lot of like raw blockchain querying. So we have our own internal, we own our own nodes, we have our own index data. We also rely on Dune quite heavily. We also use Allium. And a lot of these engines where you can pretty much write your own query over semi-indexed blockchain data is something that we find incredibly useful because it allows us to have the flexibility to say like, hey, maybe we have a new idea of something else that we want to run or test on generally raw blockchain data that we can just do that. So I think that's generally where we kind of go through a lot of these index data, or where we make up a lot of these metrics. But also like sometimes we do look at just general, hey, like we just want to have top line, active users, just as a starting point, right? Because we want to start from somewhere, get some pictures, and be like, all right, here's how things look. Let's dive deeper, and then kind of figure that out. And that's where you start running these custom queries, these filters, etc.
I love that. How about from specifically like a project team's perspective, like entrepreneurs building in this space who, because of the nature of crypto and building on chain, everything is pretty much public from day one and you kind of IPO immediately once you launch your token. You need to start thinking about like stakeholder reporting from a completely different perspective than you would have as a startup in the traditional world. So quality filters are of course one that we spoke about, but from your perspective, what kind of data and KPIs should project teams be focusing on presenting from day one? What do people want to see?
Yeah, I would say even before that, not just focusing on which KPIs, but just having an easy place where people can come to and just like pull up a dashboard or something and be like, hey, here are the KPIs. I think that makes a very big difference, right? Rather than kind of like looking back and forth at like, for example, different Dune queries or different terminals that all might not have the same exact underlying metrics. And so you don't actually know which one's the official source. Because I think most people who are not really deep in this space, they don't understand that, Dune queries are user generated, right? So they're not verified generally by teams. So having some sort of official, like, hey, here is our dashboard, here is our source of metrics that we want to show to you. I think that is something that is very important. And then as for individual KPIs, I think obviously having the top level KPIs, like active users, et cetera, or TVL, I think that's important. I mean, I think DeFi Llama does a pretty good job at, TVL metrics if you can get onboarded there. But I think that's important just as a comparative metric initially with your peer set. And I think that beyond that, it's kind of hard to speak too broadly about different projects. Different projects vary so much, DeFi, SocialFi, game, like the exact metrics that you might want to push forward, I would say kind of comes down to more of more like industry or sector specific and trying to figure out what your peer set is using and then push for that. One thing that I will say on a more personal level is I think that we are shifting more from like a story and a narrative based, environment into one that's more application and business driven. So if there's any metrics about like user retentions or like revenue per user or just total like yields and not just, active user metrics that are more easily gameable, I think that would be very, very important. You might want to put that top line. Hey, we are actually making this much money. Our users are spending an average of this much, et cetera. And then those things are going to get more and more important as, liquidity environment. The liquidity environment, to be quite frank, has been tight. And I think that as investors and traders get more and more, they wisen up a little bit over like a lot of these unlocks, having more durable sources of revenues and figuring out how investors can get their money back is going to be more important in this space going forward.
I think what you just said there is going to be one of the most important clips that any project team has heard on this podcast. That is super valuable context for them to just understand how important it is in general to have a place where you can guide your stakeholders, be they investors, users, people curious about the project to learn more. You just got to have that one source of truth that you somehow quality assure or let people understand that, hey, we're on top of this. This is correct.
Yeah. It doesn't have to be like your own web page. Like you don't have to spend as much time and effort into it. But like if you write the protocol, you should generally know, which contracts, which events you should be looking for on chain. And so if you do it yourself and it's branded under your team's name, I think that would be a much bigger, like as an investor or as someone who's looking outside into this, I can be assured that the quality of this data is correct. Because oftentimes, nowadays when I look at a lot of these like Dune or Flipside, a lot of these open analytics, sometimes I'll like do a double check, like, all right, wait, this number doesn't sound right to me. Let me go reread the query. And I'm like, all right, this is not exactly correct. Let me fork this and then make the changes. And then I'll have my own internal data. But, that's also not publicly available on oftentimes. So, the open data is great, but you gotta have some verification and give people a reason to trust the data.
Exactly. And that is kind of what we're trying to do with actually just like a week or two ago launched the Token Terminal Discover page, which is enabling analysts and project teams to start building these standardized custom dashboards based on metrics that are in one way or another like audited, so people could be able to trust them. But there's still a big development curve in the space in terms of just project teams understanding how important this is to get those things up and running. But yeah, as you're over at Coinbase Institutional, the word institutional adoption is being thrown around a lot over the past cycles. Institutional flows are coming in. Is that the truth or not? I don't know, but you're probably in a better place to tell us. So I want to speak a bit about a couple of topics within this sector. One is, of course, like the flows and traction of the ETFs, because that's been a big topic around institutional option. But just in general, when we're speaking about institutional capital and interest and where that's flowing, are you able to share about any specific trends within just crypto broadly that are specifically driving institutional flows, certain sectors or assets?
Yeah, I think Institutions are a pretty varied bunch. We have everything from, VCs to macro funds. I would say the biggest flows that, we encounter and we have encountered, and I think this should be pretty obvious, actually is just for Bitcoin. The ETF approvals, the removal of any regulatory risk, which I think, retail might not appreciate as much, but regulatory risk is huge, right? There's no point in, if you're already making, 10% a year on whatever strategies that you're making, there's no point in trying to bump that up to like 12 or 15%, but with the risk of paying, a $200 million fine that can just wipe everything out, right? So the approval of the ETFs are huge. Most of it is for Bitcoin. I think Bitcoin has a very clear narrative, a very clear story, 21 million supply, supranational asset. And I think for people who are not super deep into the crypto weeds, this really two-sentence story, it resonates with a lot of people, particularly those who are, international investors, people who kind of realize, hey, we grew up in, Russia or China. Like, we understand that, government seizure of assets is a very, very real possibility. And so that narrative has been very, very well, I guess, absorbed by the institutional class. And that's what we've seen that with Bitcoin inflows. We've seen that with, just ETF adoption in general, especially just for Bitcoin. And I think one of the big challenges, not only was it regulatory risk, it was also just technological risk too. Just trying to understand, like, how do you custody private keys? When I was at Goldman, for example, we just didn't have the infrastructure to hold a private key, right? None of the, general authentication authorization systems that we have are sufficient to custody any Bitcoin, right? Because you can imagine if your admin can reset your password, that system itself is not secure to host a private key, right? And so you have to think about, all right, then if they wanted to hold any Bitcoin, not only was there the whole SAB 121, the whole regulatory issue, even if they had that clarity, they have to figure out, hey, we have to build up these entire systems. Are we actually going to make enough money on top of any business that we do here that will make back the cost of building the custody systems? And so ETFs are a really great way around this. They're like, hey, it's actually integrated into all these other systems that we have with our connection with the prime brokers, et cetera, all these securities offerings. Like, it's fine. There's not that much of a big lift that they have to do because they're all packaged in ETFs. So I think that Bitcoin really has been the biggest narrative so far. And on top of that, it's also just Bitcoin's solidification as a macro asset that's not going anywhere. I think, even last cycle, 21, 2022, people were still talking about, oh, Bitcoin might go to zero, it might do this, it might do that. I think at this point, at least in the last 2 years, really, I haven't heard anyone really say, hey, Bitcoin is going to zero. I think, we still heard some stuff, maybe at the start of 2023, during when things were still like depths of the bear market. But yeah, recently it's just been like, hey, Bitcoin's here to stay. It could trade down to lower, it could trade higher, but it's not going to go to zero. It's not going to be like an asset class that's just going to disappear overnight, given how much of a regulatory and traditional financial entrenchment it has now in this space. So I'd say Bitcoin is really the big one, and you see that with Bitcoin dominance numbers going up over the last year. Outside of Bitcoin, I think that's a much harder question to answer. My personal take is that, and I think our take generally is that, it seems like a lot of the outside capital hasn't really been flowing into crypto altcoins as much as it was last cycle. We can look at this with VC funding, where our monthly funding rounds are still actually not even below the 2021, 2022 cycles. They're even below the 2017, 2018 cycle VC rounds. I mean, according to the DeFi Llama data. So there's still a lot of investors who are still trying to recoup capital from last cycle that is kind of preventing new capital from flowing in to crypto today. That said, there's also the higher interest rate environment that's kind of been weighing down on risk assets more broadly. I think tech more outside of crypto has been doing very well because of the AI narrative. Crypto has benefited a little bit from that, but really that's still very much focused on like the Web2 world. NVIDIA, Google, Facebook, Meta, Microsoft have been the biggest beneficiaries of this. So I would say very much it's still a very Bitcoin focused world among institutions who are not like really, really deep into the crypto weeds.
And that makes total sense when you think of it, because it's a narrative-driven world. A lot of investing is narrative-driven, like you said. Fixed supply, inflation hedge, that's the narrative for Bitcoin. It's simple, easy to understand. And from a portfolio allocation point of view, throw it into the inflation hedge sleeve of your portfolio. Whereas a lot of the discussions I had with different ETF providers and researchers, like prior to the launch of these ETFs, is that the Bitcoin ETF will probably go crazy. But then the Ethereum ETF, it's just so much harder to understand as an asset. It's a multi-dimensional asset, and it doesn't fit into the inflation sleeve of your portfolio, inflation hedge sleeve of your portfolio really much. It's more of a technology sleeve, and an investor would need to be able to assess it and compare it to the likes of, Meta or Alphabet or any other stock that's in like the tech sleeve. And that's much harder to do and requires much more education. So it was with a couple of the ETF providers where their hypothesis was that Ethereum ETF would have a much tougher start because it's harder to adopt because you don't understand what's going on there. And I want to speak about that a little bit because the Ethereum ETF came out both timing wise, like market sentiment wise, at a bit of a more difficult time, maybe in a way. But I'm sure that's not the only reason behind like the difference in their performance. So you track these flows pretty closely and their traction. Could you share your key insights on how they've been performing so far and what the key differences are between how they've been received by the market?
I think the story here is pretty clear. Bitcoin has been, a resounding, overwhelming success by any metric, really. Since January, we've had $17 billion in inflows, which is kind of a crazy number when you think about that. ETH, on the other hand, has had $562 million of outflows as of September 11th data. And it's not just the inflows that are different, it's also the volumes. So Bitcoin ETF volumes for in the month of September have had an average of 1.47 billion turnover per day, more than 10 times that of Ethereum's $140 million average trading volume. So the reception, the difference in reception, the difference in activity is huge, right? It's orders of magnitude difference in volumes, and then the flows are not even in the same ordinality, right? Bitcoin's has been hugely positive, and Ethereum's has been negative. The way I think about this, and you had a good point, which is kind of like why people would buy ETH ETFs and the story around that being very difficult to understand. Yeah, I think of it kind of being like, who would buy the ETH ETFs, right? For Bitcoin ETFs, it's people who want some crypto exposure to a portfolio that's already on, Fidelity or some other brokerage account. Traditional financial participants also want access to Bitcoin. And a big part of this is because of the portfolio diversification benefits, right? So the whole principle is, hey, I want to allocate 2% of my portfolio to Bitcoin just to have some uncorrelated returns, right? That's all about modern portfolio theory. Just decorrelated returns. That's the whole principle. If you have, two assets each returning 50%, you'll do much better than just one asset returning 50% overall, right? Because you minimize your drawdown risk. But when you talk about Ethereum versus Bitcoin, given how closely most crypto assets are correlated, you don't really get that much additional diversification benefits in a very, very broadly well-diversified portfolio when you just say, hey, we're going to allocate 2% to Bitcoin, and you do 50-50, 1% Bitcoin and ETH. That really doesn't give you that much upside or downside benefits relative to just holding Bitcoin, right? And then the people who know enough about Ethereum, who have done the research, who have done the homework, probably understand about staking, right? I mean, staking is a big part of proof of stake versus proof of work. And they might be like, hey, wait, why would I buy this in an ETF when I can buy this and stake it and get an extra 2-3% yield? So there's these kind of questions. And I think that that's also been kind of a hindrance. So I would say, A, the story of Ethereum not being as clear. B, the lack of diversification benefits beyond Bitcoin. And C, also just the lack of staking yields for those who are really in the know about about Ethereum as an asset. So I'd say these three things have been a confluence of factors that have contributed to ETH's relative lack of success compared to Bitcoin. On top of the things that you mentioned earlier, launching in summer, 2 months after the approvals, kind of hype has died down. Summer's also a low liquidity environment. People are probably on vacation somewhere. I don't think anyone's rushing back to, buy ETH ETFs, after in the middle of the summer holiday. So yeah, so this confluence of factors means that the ETH ETFs haven't seen the same level of adoption as Bitcoin's ETFs.
That's a really great breakdown of the whole situation. I tend to agree with everything that you just said there, that confusion does not help, especially when we're speaking about an asset class where there's enough confusion just about Bitcoin, which for us seems like a walk in the park. So it might be a few years' time before we see ETH ETFs take off properly. And I do feel there's still regulatory risk related to it because there's no uncertainty around the staking of ETH. So people might be wary due to that reason as well.
I will offer some words to the upside, though. I do think that the ETF approvals, though, it really does allow people to, or allow investors to look into ETH as a technology. I think you mentioned this as well. People were talking about, ETH compared to Meta or Facebook or some other technology companies. Certain types of funds have mandates where they may only be allowed to invest in certain types of companies or products, right? And ETH will fall into a technology company product. ETH can be argued as a technology and as a technological investment, whereas Bitcoin has a much harder time of doing that, given the relative lack of updates. How its narrative today is really like hard money. But ETH, given its evolving nature, its ability to kind of model its transaction revenues and kind of growth and applications, does allow it to be bought by certain types of funds that cannot buy Bitcoin. So you do have a certain type of asset class or a certain type of sectors that can buy this asset. I wouldn't say it's a huge thing that's going to be incoming, but it's something just to keep an eye out on.
Yeah, we need to offer the positive because, we don't want to sound too pessimistic, at least myself. I'm not at all pessimistic in terms of the adoption of ETH, but from the institutional perspective,
Absolutely.
everything we worked out makes sense. Zooming out a little bit, as we're speaking about kind of Bitcoin's dominance over ETH in terms of ETF flows and adoption, the metric that probably every single on-chain analyst has been looking at for years now is Bitcoin dominance. That's the one. You do as well. I know that. So how would you currently characterize the state of Bitcoin dominance in the market? What factors are driving it, and what should investors take away from that?
Yeah, I mean, Bitcoin dominance right now is at the highest level it's been since April 2021. And it doesn't seem like this trend is slowing down. And I think that it's impossible to really divorce this from the ETF story, from the fact that, hey, we have, presidential candidates who are, potentially talking about a strategic Bitcoin reserve, other sovereigns who are like looking at Bitcoin quite closely. Like the story behind Bitcoin really, really is just picking up steam, and it has a lot of momentum behind that. It doesn't seem like we're going to reverse this trend until we have a very high liquidity environment. Maybe after rates come down, if we see another altcoin driven bull market, that could drive Bitcoin dominance down. But it seems, current inflows, the current way that non-crypto natives are viewing crypto. So really everyone else outside of crypto, the way they see crypto is really, hey, I want to buy Bitcoin and I need a reason to buy anything else beyond the Bitcoin asset, right? Like, why would I buy anything beyond Bitcoin? And this is a much harder narrative to sell when you're talking to people who don't really understand, what a decentralized application is. They don't really understand what smart contracts are. They don't understand why they might need this when they can just use their bank or use Venmo. So these are all sorts of narratives that kind of need to work their way into the market. Investors kind of need to eventually get the education, and that needs to be more commons-based knowledge. But it does seem like Bitcoin dominance has just been up and to the right. And it doesn't seem like that trend will slow down until we have potentially another low liquidity environment that just drives huge risk assets or a huge risk on attitude. Another thing that people kind of look at as well is like USDT, USDC combined stablecoin market caps as inflows to the altcoin asset, to the altcoin space, because these are generally on chain. You can buy altcoins with this via, on-chain indexes, etc. And they're currently in USDT and USDC market caps are at all-time highs, $154 billion, but it's still below the peak of 2021 when you include, stuff like DAI or, the Terra Luna algorithmic stablecoin. That's one part of the story, which is like actually the total stablecoin market cap isn't as high. And second of all, like the leverage in these stablecoins is also not as high as they were last cycle, right? So clearly, the Terra Luna stablecoin was just pure, it was purely algorithmic, didn't really have much backing, but people were using it to buy and prop up different currencies because it was being treated as a US dollar. And so you have this lack of leverage that hasn't been really making its way through the altcoin space either. And so it does seem, generally altcoins are still very risk off. A lot of kind of capital rotation among the crypto natives, whereas the only new capital inflows are coming via the ETFs from an outside asset class that's not going to be able to be rotated down into these other assets or these other altcoins because they're locked in ETFs, right? You're not going to go from a Bitcoin ETF holder down to someone degenning on a yield farm on some new L1, right? That flow doesn't really, that chain is broken this cycle.
Yeah, I think that's a very important point. Probably a lot of people don't realize that the capital is locked in the ETFs and to that extent, so it can't even flow that way. Too much friction. Yeah, well, we need to bring the ETFs on chain at some point, and then that kind of builds on RWAs and just the tokenization of everything that's happening. And I want to go into that next, but I feel it actually makes more sense to speak a little bit more about Ethereum at this stage. As Bitcoin is dominating the space, and Ethereum is from a narrative perspective, been in a bit of a lull, unfortunately. I feel like for over a year now, it has kind of lost the ultrasound money narrative more recently to some extent. And part of that, of course, has to do with the EIP 4844 dropping the fees down. Like ETH supply is inflationary again. They're capturing much less revenue from all of the activity. L2s are benefiting from it because they have lower fees and they can kind of build up adoption. So it's like good for the broader Ethereum ecosystem, but at the same time, from the economics of the base layer protocol, Ethereum, it looks not as good as it used to look. And a lot of people are wondering what's going on here. And you recently put out a piece called Ethereum and the Rise of L2s, where you kind of touched on this topic and concluded that you think that the L2 roadmap might be slightly extractive to ETH. And I think that's a really interesting take. Could you explain why this is and kind of the whole situation with Ethereum and how this might impact Ethereum's long-term value proposition?
Yeah. That's a great question. Let me start with take a step back. And you talked about Ethereum losing its ultrasound money narrative and how it's kind of been an underperformer relative to some of the other coins. Solana in particular comes to mind, or even just Bitcoin, right? Even Sol BTC is down year to date, right? So Bitcoin really has just been blowing everything outside of the water. Ethereum, in my opinion, really lacks a good elevator pitch, a good sticky elevator pitch that doesn't really change year to year, right? You can't really change from 2 or 3 years ago, like, oh, Ethereum's ultrasound money, this is why you should buy it, to now in 2024, it's no longer ultrasound, why should you buy it, right? So you can't really change these narratives every 2 or 3 years. So I think that Ethereum has this lack of an elevator pitch problem. And, ultra money thing, revenue fees, and burns. There's also the whole idea of ETH as decentralized money. There's the idea of ETH as a settlement layer. It's the most secure decentralized network, but there's nothing that's, hey, this is the reason why you should buy Ethereum. It's, hey, here's a confluence of factors. You can pick and choose which one you like. I can't guarantee it'll still be here in 2 years or 3 years, but good luck, right? That's kind of the feeling that when outsiders look at Ethereum, they're like, what am I buying here, right? What am I going to buy here that I can hold for 5 years, right? And I think that's kind of where Ethereum has this challenge. My thought process on the L2 piece of the question and why L2s are only slightly extractive is I think that, Ethereum, a lot of people in Ethereum and in crypto in general have been talking about, hey, we need scalability. We need scalability. Scalability is the most important thing. And that's really what L2s have brought. But I think in the paper, I did a deep dive on this, and we've actually seen a 20-fold decrease in the average ETH denominated transaction cost. So that's a huge, huge decrease, 95% reduction. But we've only, and I use quotes, only seen a 10x increase in transaction demand, right? So if you have a 20-fold decrease in cost and only a 10x increase in transaction counts, then your overall revenues is going to drop. And I think people have been kind of pointing to, like, hey, L2s are extractive. That's why we have inflationary Ethereum. One thing that most people don't realize is if we burned all of L2 transactions, right? Forget about sequencer profits, forget about all like the L2 different types of fees. If we burned every single L2 transaction fee today, ETH would still be inflationary. And I think that's kind of not really appreciated, right? People are thinking like, oh, sequencers are capturing a little bit of revenue, a little bit of profit here and there. And yes, they are. They're capturing, a few 100,000 to a million over a year's period. But at the end of the day, like that's inconsequential or very, very nominal relative to how much ETH is being issued. And I think that the amount of ETH that's being issued in the whole inflationary problem, if it is a problem, it comes down more to how the staking yield curve is done. So, as more ETH gets staked, more total ETH gets issued. And we've just seen the ETH staking participation rate just go up and to the right. So unlike, say, for example, Solana or Bitcoin, where you have a fixed number of ETH issuance, or where Solana and Bitcoin have a fixed number of issuance, regardless of how many people are staked, and they all divide that pie. For Ethereum, the amount of issuance actually just grows as you have more stakers. And that's really been one of the bigger drivers of, the ETH inflationary phenomena that we've been seeing over the last month. I mean, on top of transaction fees lowering.
The space has been so focused on just improving tech, improving scalability from that perspective, that right now we're in a situation where scalability is kind of front run adoption. And even with Ethereum, we need apps. We need to start finally focusing on the application layer, which is pretty cool of a situation. But from an economics perspective, people just need to understand that we're front running things here. So patience.
Yeah, I definitely agree on that.
Let's go back to your Goldman experience now. I said that we need to tokenize ETFs, which actually, now that I think about it a little more, is kind of funny that probably might happen at some point. But we go from an on-chain product to turning it into an off-chain product, an ETF, and probably tokenizing that again. So a weird loop there. We'll see if that ever happens. But you were in the real-world asset space pretty early on. Like you joined the digital asset team at Goldman, setting up a tokenization platform. As a topic, tokenization and institutional adoption are usually always in the same sentence. So could you share a bit about your key takeaways from that experience in helping building out that platform?
Yeah, definitely. I think the biggest takeaways for me, there's so many takeaways. I don't want to ramble too much here. The first one was just realizing how important or how much cost savings could be done using blockchain technology, right? I think when we were first analyzing our tokenization platform, we were looking at existing processes and kind of comparing them as, hey, as a business, we're like, is it going to be eventually cost effective? Are we actually going to make money doing this or save money doing this? And kind of walking through this stuff, even as an engineer, you have to understand like, all right, what are our existing middlemen? How much are we paying them? What kind of reconciliation costs are we doing? And it's a lot of money that a lot of these firms are paying just because they each have their own database. Really, that's what it is. It's, hey, I have my database of transactions. You have your database of transactions. Maybe we'll reconcile with a third party. Like, it's crazy. I think one of the projects I was working on, even before I was on the tokenization team, was trying to automate a way to process emails, because us and our partners, we would just be like, hey, I owe you this much money and this is what I see on my account. And then they would respond with another email saying, oh, I see this much. And then they would have to net the difference, right? And there's just, thousands of people in operations literally just handling hundreds of thousands of emails every day, just literally emailing, hey, how much money do I owe you? How much money do you owe me? Like, that this back and forth is a huge, huge operational cost for a lot of these firms. Not just operational, it's also operational risk. What if these numbers are incorrect? What happens? How do you resolve these disputes? So kind of realizing, hey, like once you get behind the scenes outside of, say, like, some of your easy like Robinhoods or some of these other Fidelity apps where everything is nice and like instant for you as a user, the back end of it is actually really messy. And so I think one of the biggest takeaways was realizing, hey, like this blockchain stuff is really, really, really useful. That said, the second takeaway though, on the other side is it's also really, really hard to implement this in the context of an institutional kind of framework, especially on a public chain. So a lot of these institutions, they have very, very heavy like technology risk kind of requirements, right? So if they open up and they start using a public blockchain, what kind of attacks are there? If they start using smart contracts, what are the downside risks? And a lot of these big institutions are really, really focused on mitigating the downside risk. So there's technology risk, there's regulatory risk. So a lot of these businesses are still profitable today, and they want to increase their profits, but they don't want to potentially just lose their entire line of business, right? It's not worth it from a why would you make that bet? And so this kind of spans across a whole bunch of ranges: technology risk, regulatory risk, private key, hack risk, smart contract exploiting risk. The list just goes on. And I'm sure, when you look at, public blockchains, you just see, hey, there's another hack this day. 1 week later, there's another hack. Maybe the next day there's another hack of some sort. Someone else lost their private keys. This stuff really is not acceptable in the institutional space. And so I think that the real big focus on just mitigating the downside risk is something that is very different from the institutional view versus, say, the retail, the consumer view, where it's like, hey, we're going to build these tools, consumers can use it. They got to educate themselves on storing a private key safely. But if they are not smart about it and they upload it to iCloud and the iCloud gets hacked or whatever, then that's like on the user. Whereas institutions, they can't really do this. They say, hey, we're responsible. If we lose a private key, we have to do this, we have to do that. There's all these things that institutions need to care about that might not be as transparent to the retail sector.
Yeah, that makes a ton of sense. And I think like one notion of blockchain is like a core value proposition for us who are crypto native. And from day one has been the fact that they're open, public ledgers that anyone can kind of come view. But from an institution's perspective, that's not necessarily something that you want. You don't want it to be public, even though that's
oh crap, it's open, it's public. Like that was another thing that we actually had to deal with, which was how do you deal with private data? Because you don't want people to see that. Only the involved parties should have that knowledge of something that's happening. And that's a whole another story of like why we went with the private blockchain. That's why we didn't even use like an EVM fork, because we had to do everything privatized. So it was like there's a lot of things that retail doesn't have to think about that institutions do care about, and there's a lot of regulatory requirements as well, right? Even dealing with laws as well. I'm just going to throw another point in here. Like when I was there, we were dealing with mostly bonds, and we did 2 issuances, one under Luxembourg law, one under Hong Kong law. And just the process of we had to modify our smart contracts to fit into Luxembourg law. We had to modify them to fit into the way that Hong Kong redemption clauses work, which is different from Luxembourg redemption clauses. And so the actual redemption and asset servicing, like when you pay the interest of the bonds, is different under these different jurisdictions. And it was to the point where, some of the lawyers that we had were like, hey, you can't even name a variable a certain name because it has a different context in legal versus, even though in technology, like in variables, you can call it X, you can call it Y, you can call it whatever. But if you use a certain term, then it's, hey, this might have a certain legal opinion attached to it. So you can't even use that just to keep ourselves safe. So there's a whole bunch of issues that institutions really have to deal with, that have to dig into, that really kind of prevent them from just going straight in, diving into, hey, let's just do something on a public chain. I was there when we were like looking into these things at Goldman, and eventually they were like, all right, hey, this is actually not feasible given our risk tolerance parameters. So I think there's a lot more behind the institutional doors that's not really appreciated by retail looking at from the outside looking in. You're like, why can't you just do this? There's a lot of reasons why they can't.
Super interesting context. And on the tokenization side, then, final question, a quick one really, is that given everything you kind of laid out there, where do you see tokenization having the most immediate impact? I mean, we have dollars on chain. That seems to be a killer use case. That's working. But what's next? Yeah,
this is a great question. I mean, stablecoins, super amazing. USDC, just being a way to do international remittances. My personal opinion about the real impacts of tokenization is that it might not actually be felt by retail in the short term. I think that there's a lot of tokenization efforts happening by institutions on private blockchains behind closed doors that you probably would never understand or just even know about unless you're like kind of in the space. And I can give you one example of them that was at least starting up during my time in banking, which was the whole idea of collateral mobility. So when you trade a stock, usually it takes some time to settle, right? So even though your transaction is instant, that's just a guarantee by the exchange. And at the end of the day, they have to go to a clearinghouse and say, hey, actually now the security is officially under your name. We move it to your exchange. Banks have certain types of requirements where they say, hey, we need to have a certain amount of collateral to back up certain positions. They're regulatory requirements, but your positions are going to be changing intraday, right? So every hour, every minute, they're going to be changing, and that's going to change your collateral requirements. But your collateral requirements can only settle, before blockchains, they can only settle at each day. At the end of each day, you can sell all this collateral, which means that you need extra collateral just to make sure you're on the safe side, right? And that's that's like dead weight capital. It's just capital that's sitting there, not really doing anything. So there are certain types of blockchain systems now that actually allow you to do intraday settlement of certain types of security assets instantaneously on a blockchain. And that will be able to account for this regulatory requirement, which means that you can really unlock somewhere between in the tens or even hundreds of millions of dollars that you can actually use for other productive means, right? And so you can think about how much money you can make. If you had $100 million of free capital, that's a fair amount of money if you have that per day, right? Just into infinity. And so there's a lot of benefits to tokenization that's happening behind the scenes. I think the big challenge for retail tokenization that you and I might use on a daily basis outside of stablecoins is KYC and regulatory requirements, right? A lot of these, like counterparty risk is a huge thing in traditional finance, where if I'm sending you money, I need to know who you are. I need to know if you're allowed to receive this. I need to know if you're an accredited investor, if you're an institution, where you're located. If I send you this, security or I guess token, what kind of legal jurisdiction will there be if there's any sort of dispute? So there's a whole host of this whole regulatory and legal questions that is kind of impeding, I would say, retail adoption a little bit, which is also why if you look at a lot of the retail tokenized money market funds, etc., they're all not very liquid. You need to be on a whitelist. You need to do a KYC process. If you want to send it to someone else, they also need to be on the whitelist. And then a lot of these protocols have independent whitelists because they all need to undergo their own KYC process. So there's a lot of frictions in this space. A lot of them is legal driven, regulatory driven, that I think won't be smoothed out so closely in the short term, at least not without legislation that will benefit us all.
That makes absolute sense. Pivoting back from institutions to more things that are happening on chain, the protocol levels. One recent research piece that you also wrote that I was very ecstatic to see was related to token inflation, because that is a topic when we're standardizing metrics, we get a lot of backlash on. We see it as an expense. Protocols issue tokens to coordinate specific activities, incentivize different stakeholders, and it is essentially in a sense to the protocol. And that's how we've kind of standardized it. And we go back and forth with a lot of protocol founders and core teams on Twitter about this topic. And I always like to see analysts kind of chime in and see how they analyze the metric itself and how they position it against everything else and what kind of quality filters should be added on top of it. And I think the key takeaway from your article was that it's a metric that needs to be considered, but it's often misunderstood. Let's speak about what that misunderstanding is here. Could you walk us through your thinking about token inflation in general?
Yeah. I mean, token inflation, the reason why people care about token inflation, I mean, just more generally, is because they want to figure out is if new supply is going into the market, if that's going to cause long-term sell pressure. I think ultimately that's what people care about, right? If you have, a rebasing token where everyone gets more of the same amount, whatever, right? This Ample4, there's other sorts of rebasing stables that do this, or staked ETH, Lido staked ETH, that's also another rebasing token. People don't really care about this type of pure inflation numbers. They care about, hey, if we're issuing new supply to a certain sector of the token stakeholders only, what are they going to do with this? And the assumption is everything that's being issued as part of this inflation is going to be sold. And I think that in the long term, this might be true over the course of, years, maybe decades. But people kind of misinterpret this to say, hey, there's this much inflation. That means that there's going to be this much sell pressure every single day. And I think that that's not true for many, many different tokens. And I think that that's kind of when you have to say all right, so we have this long-term sell pressure, maybe long-term potential sell pressure that goes out into the year-long or multi-year range. What's going to happen? How is this going to impact flows in the short term, right? In the weeks into the months. And this is where you have to go beyond the headline inflation number and look at, hey, let's look at the behavior of the people who are being issued these tokens, right? And so I look at it, for example, proof of work versus proof of stake. That's probably the biggest divide here. Proof of work people, especially Bitcoin miners, it's a very cost competitive environment that constantly has decreasing profit margins, right? Every halving, your profit margins go down. As more miners join the network, profit margins go down. So that's one area where this inflation, really does translate directly into sell pressure on the order of weeks, potentially months, right? Obviously, you have a few outliers like Marathon is financing the purchase of additional Bitcoin. But if you look at overall on-chain data, Bitcoin miners have actually decreased their holdings since 2021, right? Which means that all the Bitcoin that's been mined from 2021 till now, and then some more that was mined earlier, has all been sold into the market. It doesn't necessarily mean like a market dump. They probably have OTC deals. Some of it is hedged, of course. But in general, there is new supply that's entering the market that's being sold. It's, Ethereum when it was proof of work before the merge, similar story. But then when you look at proof of stake networks, Ethereum is now proof of stake, Solana, some of these things, the inflation story really isn't so straightforward. Obviously, you have their headline percentages, but then the question is, how does this translate into flows that's happening over the next few weeks, next few months? Ethereum, when you look at staking, for example, we've actually had net inflows into the amount staked, right? So we've had around less than 2 million new ETH issued since the start of 2023. This is not including the burn. So we had just under 2 million issued, but we've had almost 18 million ETH, being put into the staking platform, which means that staking actually is a net supply sink of ETH, right? Regardless of whatever inflation rate there is, it's, hey, more ETH has actually flowed into the staking, complex than has flowed out of it. So it really is a net supply sink. Solana actually has had, since the start of 2023, has up until 2 or 3 months ago, or actually no, March was up until about 6 months ago, Solana actually had more and more inflows into their staking complex as well. So the amount of inflow of SOL into the staking complex outpaced whatever issuance existed. So it was also a supply sink. But that shifted towards the tail end of March and to early April, so 4 to 5 months ago. And then that's actually kind of crossed over that line. So I have some pretty nice charts inside the paper. You can actually visualize. You can see, hey, here's where the net issuance should be. Here's the stakeholder growth. And so that represents overall a net intake into the staking supply. But then Solana kind of crossed past this line and, hey, actually it's net selling now over the last 2 or 3 months or 4 to 5 months. But that's kind of where the inflation headline does matter long term. But you have to kind of put that into context of what are the validators or the stakers or the people who are actually receiving this inflation, what are they actually doing with this asset?
That is super interesting. Now, I need you to build some more custom metrics in addition to the H index around token inflation to just bring some more levels to the quality of it so people can compare them between projects.
Maybe. We'll see. We'll have some. Yeah. We have some stuff in the workbooks.
Cool. One thing that came to mind based on that is, how does liquid staking then affect the fact that staking itself is a net supply sink? But the fact that, for example, on Ethereum, the majority of staked ETH is liquid staked, whereas on Solana, it's a very, very small portion that is liquid staked. Does that affect how you view token inflation as a metric?
It definitely has some impact. I would say that it is not as large of a consideration today because the liquidity for liquid staked tokens is not as high as it is for just unstaked ETH. So if you look at the curve pools, you look at the Uniswap pools, even if there is some sell pressure that's being done via the liquid stake tokens, it's not to the same extent of, hey, we're just going to dump everything consistently. Otherwise, you'll start having some depeg opportunities. You'll always have people running these ARBs. So I think net, it won't make a very big difference in terms of staking inflows and outflows. Yeah. I think it's just high liquid staking. Actually, I think it's a positive in terms of liquidity and just bringing more liquidity into the system. I know there's centralization concerns, etc., but I wouldn't say that it factors too greatly into the inflation question, but that's a great question. Maybe I'll have to revisit that if someone has evidence to the contrary.
Yeah, super interesting. Maybe we need to see a part 2 of, definitely want to see a part 2 of the token inflation metric as things develop in this space and we get a better understanding of how tokens are used and how inflation affects kind of unit economics and everything else like that. But at this stage, this has been a super insightful, compact session. I really appreciate the insights. I know that I've been listening to the institutional market calls on Coinbase's YouTube channel. You spoke a lot about Solana and TON as well. And I encourage everybody to tune into those calls because you share some good stuff and insights, because I think verticals where we're seeing growth is quite different than what we discussed here during this episode up until now. So very different use cases within crypto, which is cool to see. And I feel that they would be channels for some mass adoption. So could you share a bit of those insights on what you're seeing happen on these networks and from an institutional perspective, what investors should be focusing on?
Yeah, this is the growth of Solana, TON, and some of these other alternate newer L1s has been really interesting because it kind of shows the shift of crypto as a money to crypto as a technology. I think, for example, TON might be the farthest right, where a lot of the discussions that we've been hearing around that have not really been focusing on like decentralization or uptime. It's more about hey, here's a platform, here's how many users it has, what's the average revenue per user, and so really you're starting to push the boundaries from hey, like we're decentralized money into what's the revenue? Like, let's raw these numbers and just figure out how much buy pressure there'll be from transactions. And so really you have this full range where Bitcoin on one side is like, hey, it's like money, it's decentralized money. We have this million supply. It's a supernatural asset. So on the other side, especially with a lot of the newer changes, hey, we're a pure technology play. And we can't compete on the tokenomics or some of these things, but we are going to have adoption from apps. And so I think that that's kind of a big investor mind shift as the industry has matured, where you originally had a lot of cypherpunk ideologies and you're transitioning into a lot of just going to be VC funded. We're going to grow and we're going to acquire users and we're going to make money from our users. So I'd say broadly, that's kind of one trend that we've been seeing with Solana, TON, and a lot of the long tail of altcoins, which is more of a technology play versus a crypto as a money, crypto as a token or liquid token globally, which it still is, but there's none of that. No one that I've talked to at least has been like, hey, we're buying TON as a hedge against inflation, right? That narrative just doesn't exist, right? And so I think that's something that's really interesting to see as this industry is kind of evolving and maturing, and the technology just gets better and better and more integrated into other non-crypto technologies like Telegram or these other Web2 platforms.
It definitely is, and I think especially on TON, something that I love is the fact of how seamless it is, like the idle games and everything as onboarding channels for crypto. It feels Web 2y, and that is what we need in terms of UX. And people really just don't have any idea that they're necessarily interacting with crypto. So it's a great trend to see. David, truly appreciate all of your insights over this session here. In terms of upcoming kind of research and what you're working on right now, is there anything you can share that listeners could be looking out for?
We have a number of big reports coming up. I think the biggest one would be the biggest one that we can talk about would be the 2025 year ahead outlook. I know it's almost a settlement. It's only 3 months away, but it's quite a fairly beefy report. Definitely worth a look. And if you want to see any of the other reports that we have writing, that are the weekly, the monthly, the other market intelligence reports that are coming up, definitely sign up for our newsletter. If you just search up Coinbase Research, you'll see a little email sign up form on the bottom of the page where you can get everything in real time.
And I will be adding a bunch of links to the show notes here on everything that we kind of discussed here, because I highly recommend everyone read those and stay up to date with everything that's coming up. So thank you, David. Appreciate your time and hope we can do this again sometime.
Thank you for having me.